on FedEx, FDX. Implied volatility rank is right here. Okay, that number right here that I'm circling. What does this matter? Okay, what it means is that is the implied volatility rank for the last 52 weeks. Now, some people use 30. 52 is the right number. Okay, they have a great mathematician over there, and he did a lot of academic research, and he found that IVR, you should use the 52-week IVR to make your decisions rather than the 30-week. Why? Seasonality is heavily involved in that. So keep in mind that right now we're trading in an elevated volatility environment that is statistically likely to be as much higher than it was last year this time in terms of seasonality. Remember, September of last year, markets were going higher. Had a little bit of seasonality, but we went higher into November, higher into December, higher into the beginning of the year. So the implied volatility rank is all of the volatility of that stock over the last year. And then what percentile is today's volatility compared to this stock relative to the stock's volatility over the last 52 weeks. FedEx right now is in the 68th percentile. And the general rule for IVR, implied volatility rank, is you only buy calls when vol rank is under 20 or 25 is fair enough. You sell puts, you buy calls and you buy puts when it's under 25. You sell calls and you sell puts when it's somewhere in the 25 to 50 range. When you start getting into this environment, this very high volatility environment, that's where the advanced stuff comes in. That's where the iron condors come in. That's where some more advanced spreads occur. It's also a time that you're deep now into a cycle of volatility with some of these stocks. And if you're new to this, sometimes the best thing to do is nothing. Sometimes the best thing to do is sit on the sidelines because the cost of the insurance is so high. And you have to remember this. You are out there, you're trying to buy, we're buying calls on the SH right now. Maybe we would buy puts on the SPY. But while we're doing it because we're trying to take advantage of falling prices. We're trying to effectively bet that these things will go lower. It is very hard to short. That's why I don't do it too much. I focus a lot on the SPY. I focus a lot on the big indices. I don't overdo it. I tend to limit it to the beginning of a negative momentum environment when we flip negative, because that's where capital tends to leave the market the fastest. So in this situation, remember, we're buying puts. We're saying, all right, well, let's look right now. Let's go out right now on this stock, FDX. We'll go to the 21st. Look at October 21. Oh, and the 125 right now, the 125 put is $1.50. That's extremely expensive. That's a very expensive trade. Why? Because you need the stock to fall to 123.52 to break even. But you're also paying more because remember, volatility, the cost of volatility is baked into the option. The implied volatility, that high level of volatility that you're looking at, the fact that the VIX is in the 30s, that drives up the cost of the insurance. The purpose of a market is to sell. Remember that before anything else. The purpose of a market is to sell. So in this environment, market makers are selling insurance to companies, to traders, to funds at an elevated price because the market is extremely volatile and there's a lot of fear. And somebody who's been holding FedEx for a long period of time, looking at this at 144.20, right? Well, if VIX was down around 20 right now and it was like a normal market, that 125 call or put, it might be around $1. Maybe it's down around 80 cents. But right now it's elevated. Right now you got to pay $140 to insure every 100 shares you own in case this stock falls below 125 in October, which, by the way, it could. Because in this environment, if capitulation kicks in, you're not looking at 144. You're looking at about 105. You don't know what could potentially come. But remember, as volatility increases, the cost of that insurance increases, and that's what you're buying. So there are other things that you could do. You could sell contracts. You could sell a call spread to the upside. You could sell a strangle that's way out of the money. You could be selling maybe the 105, the 110 put right now for October 21st, and maybe the 165, and you can squeeze a couple of small gains out of it. There's going to be a very high probability of profit doing that trade, but I promise you that if things go wrong, that is picking up pennies in front of the steamroller. That is an environment where volatility is elevated. So you say, well, I'll sell contracts around this, and I'll go down to I'll sell the 125 put for October 21st, and I'll sell how about the 162 call, right? Let me show you this real quick. Because this is what a lot of people do. This is what a lot of the best traders in Chicago do. This is why they make money constant, during a long periods of time. But then you have this one kind of black swan event or this giant credit event, and then all of a sudden they get crushed. Remember, I have a very good friend, hedge fund trader, made a lot of money, took an AUM from $250 million up to $700 million, and then COVID crisis hit. And because he was picking up pennies in front of the steamroller, he lost $1.5 billion in 3 weeks. Victor Niederhofer, this has happened to him 3 times. Doing these light trades, here's a strangle, right? Let's look at FDX, okay? All right. I just want to point out, when you do calls and puts, yes, you have a lower probability of profit sometimes, right? You're going to be down around 25, 30%, but at least you know how much you can lose. That's a really important lesson. So now in this situation, let's say that we're doing a strangle and we're writing both of them. And we wrote, let's go with October 21st, 125. And let's say that we wrote the 165. Okay. So that means over the next 3 weeks, 4 weeks, you could make $252 trading this strangle with an 81% probability of profit. Let me show you what happens if the stock goes to 105, or maybe the Federal Reserve comes in and just pumps money out of the sky, which, who knows, maybe they will. In the event that the market just completely cratered and this stock fell to 105, you lose $1,800. So you can make a little bit of money here. Hey, wee! I made $252. But if this market crashes in a high volatility environment, Putin sends a missile into space, we have a supply chain issue, we have a hurricane issue, we have something that just comes out of nowhere, that's how much money you can lose. If you are not advanced at this stuff yet, don't start doing it now. Volatility is high. Something that you could do with the FedEx. Okay, let's just say that we think that FedEx is going to remain lower for longer. There's nobody coming to save this market. You could do a spread, a call spread, and again, you can define your risk. So in this environment, let's say that you bought the $165 call for October 21st, and you wrote the 160. Okay? You bought the 165 call and you sold the 160. This is selling a spread. You will make $68 on what is effectively needed of $432 in margin. And this is what your spread looks like. If the stock gets above 165 or 160, that's where you're taking on water. The most you can lose is $432. You are trying to make $68 or 15.7% or an annualized 221% return by doing that. And here's your probability of profit of 82.3. Why would I want to make that trade? Higher probability of profit. Not a bad return on investment, right? $15. Am I going to do 10 of these? No. Will I do one of them? Maybe. It wouldn't be a bad trade. But why would I not do this trade? Well, one, the company is deeply oversold. And two, the SPY is deeply oversold. And if we get any rebound rally, short covering, whatever it is, can this stock go to 160, 165? I don't know. But from a general rule, if I were trading this and I were setting a stop of 100%, and what I mean by that is I get $68, and then all of a sudden the value of this contract moves to $130, I'm selling it back and I'm taking the loss because I don't want to turn a $68 gain into a $432 loss. We are in very extreme oversold territory on this. So maybe push it aside. Maybe look for a company that's trailing down, moving lower momentum wise, 40, 45 on the RSI, and maybe then sell it. Or maybe you wait for a company to move into overbought conditions, and then you sell the spread because the expectation is that the stock will sell off. When you get down into these really ugly periods, like we are in right now, and I stress this because I don't want you to, I want you to understand. I mean, if especially if you're new here, thank you for being here, but I don't exaggerate. I'm not a person who comes on and says that, gold's going to 1,000. I don't do that. Or I don't say, I don't get into hyperbole because I've spent my life dealing with financial crisis that I know what it looks like and I know where the bottom will form. So again, I point out, this is not hyperbole what I am telling you in this situation. What I am telling you right now is if you look at this chart, this is the most net positioning to the downside of the S&P 500 since the COVID crisis of 2020, when the S&P 500 fell by about 33%, the 2015 crisis involving China, the 2011 crisis that involved Europe and our debt ceiling, and the markets tanked. And you probably remember 2008, the first little blip on the bottom left, that is Bear Stearns, and the one on the right is Lehman Brothers. Net short. And in every one of these situations, Federal Reserve stepped in here, government fixed its fiscal policy, Chinese central bank came in, devaluation, but fixed its situation. 2020, Federal Reserve dropped $25 trillion from the sky. This is the worst situation that we've had in multiple years. I don't know where the bottom is, but I do know where the bottom is identified. And until I see either the Fed move, the Fed pivot, the Fed cut rates, the Fed provides some level of shift in its policy, or we see a dramatic level of insider buying, I'm not going to call the bottom. And if that's the case, I'm definitely not going to be selling puts because these things can break down further. These were heavy capitulation moments in time. We had capitulation in 2020. We had capitulation in 2008. We had capitulation in 2001. We had that historical move on the VIX where we went above 40. And we are not there yet. This is very important.